Inevitably, when we have capital assets, we run into the additional accounting that we have to perform in order to match the cost of that capital asset against the revenue it produces. And this is typically called depreciation or amortization or depletion. And that's going to be the subject matter of this video. Before we center on some of the methods and computations for depreciation, sometimes on the exam they like, especially since depreciation is such a covered item in accounting, sometimes they like to ask questions not about the calculation of depreciation, but some of the theoretical concepts. So I wanted to go over what I think are probably the most important concepts, and sometimes can be subject to misinterpretation. So I've got a couple important things to remember here regarding depreciation. Now, the formal definition of depreciation, it's the process of rationally allocating, we'll talk about the word rationally allocating, the depreciable base of a tangible capital asset over its expected useful life. Now notice I use the word tangible capital asset. That means that's depreciation. If it was an intangible capital asset, it would be amortized. If it was a wasting natural resource, it would be depleted. So you need to make sure that you need to make sure that those terms are used correctly by yourself if there's any questions about them in the exam. Now, the process of rationally allocating, that means the cost of that capital asset is matched to the revenue it contributes to producing. The depreciable base means that is the amount of in effect, the cost of the asset to be rationally allocated. And it's not always the cost. It could be a cost and less salvage value, or there could be not only the cost of the asset, but the cost of the installation, moving in, and so forth. That would be part of the depreciable base. Also, we say over its expected useful life, and this is where we have to be a little careful too. That is the period where the entity expects to receive services, in effect, economic benefits from that asset. Do not confuse with expected useful life or expected economic useful life with the life of an asset. You can have a delivery truck that lasts 10 to 15 years, but probably because of the usage and the business side of the truck in terms of dependability, it's probably got an economic useful life of maybe probably about 5 years. So you wouldn't depreciate it over those 10, 15, 20 years. You depreciate it over the economic useful life. Now, something else that even a number of current accounting students make a mistake with is that basically, again, the depreciation process is a method of matching the cost of an asset to the revenues it produces. It is not. And again, it is not a valuation method. So the net book value or the carrying value of the asset is only equal to the actual value of the asset by accident, or quite possibly on the day you actually purchase it, because at that point you've come up with an objective arm's length type of transaction between a willing buyer and a willing seller. But after that, then it's really not a method of valuation. The carrying value, net book value, then is basically a concept of what's left over in terms of the cost of the asset to depreciate, not valuation. So keep these concepts in mind. This slide provides two different methods of calculating depreciation from the same asset facts. So let's take a look at the asset facts first. Our asset cost is $200,000. The salvage value for this asset is $20,000, and the economic useful life is 5 years. So let's first start with our straight line depreciation calculation method. Again, our formula is our depreciable base divided by the useful life. That's straight line. Now remember, our depreciable base equals our asset cost minus our salvage value. So if we look at the example here for straight line for this first year, it's going to be $180,000, which is the $200,000 minus the $20,000 salvage value divided by the 5 years. If we multiply that out, that's going to come out to a total of $36,000. So we're going to depreciate that asset by the amount of $36,000 a year. So we take a look at our depreciation expense for the first year, and our accumulated depreciation is equal to our previous year's depreciation, which happens to be 0, plus the $36,000 depreciation expense added. So our accumulated depreciation is $36,000. Our carrying value then is a $200,000 asset minus its accumulated depreciation. So we now have a carrying value of $164,000. Let's try year two. Year two, again, we have $36,000 worth of depreciation expense, and our accumulated depreciation is equal to our previous year's depreciation of $36,000 plus the $36,000 for year two. So our accumulated depreciation is $72,000. $200,000 asset cost minus the accumulated depreciation of $72,000 gives us a carrying value now of $128,000. We can continue this process all the way through year 5, adding $36,000 of depreciation each year. And of course, at the end of 5 years, if we total all the depreciation up, it is going to equal the amount that we should have depreciated over the 5 years. And our accumulated depreciation, as we accumulated upon the previous year, is going to equal $180,000. So our accumulated depreciation expense should always be equal to our total depreciation expense for that asset. We also see that over the years, our carrying value now has been reduced to $20,000, which represents the amount of the salvage value of that particular asset. Now let's go on and take a look at calculating declining balance for the same asset facts. And what I'm going to do is I am going to change the color just to make it a little more distinctive here, since I've got a lot of red markings. Now again, the formula for declining balance is the carrying value minus the declining percentage. And again, carrying value is equal to my asset cost minus my accumulated depreciation. Now the question is what declining percentage do we pick? As I had mentioned before, what you do in declining balance depreciation is pick a percentage that is larger than the straight line percentage as we talked about in the previous slide. Now in this case, I have picked a declining balance rate of 40%. We call that double declining balance depreciation, and here's how you calculate it. In this case, if this is a 5-year life, if I use straight line depreciation, I would be depreciating 20% of the asset per year. but I'm going to use a technique called double declining balance depreciation, which means I double the amount of the per year percentage. So the example in this case is going to be that 20% straight line depreciation, and I double it, multiplied times 2, and I end up with a 40% declining balance rate. The other popular method that is used other than double declining balance is what we call is basically 150% declining balance, which means you take 150% of your straight line rate and depreciate it that way. Now in this case, we're going to go ahead and do the declining balance calculations. First of all, the beginning carrying value at the beginning of year 1 is going to be $200,000, because that means that's my asset cost minus any accumulated depreciation, which I show right here. So my beginning carrying value is going to be 40%. So I multiply the $200,000, and I'm going to do a multiplication sign here. $200,000 times 40% means my depreciation expense should be equal to $80,000 during year 1. Therefore, if I started out with 0 accumulated depreciation and I add $80,000 worth of depreciation to it, that means now my accumulated depreciation at the end of year 1 will be $80,000. If I want to calculate my carrying value, it's simply my beginning carrying value minus my beginning carrying value minus my accumulated depreciation. That ends up with my ending carrying value of $120,000. Let's try year number 2 now. We now have a beginning carrying value of $120,000, and that came from our previous carrying value from the previous year. We multiply that beginning carrying value again times 40%, and that's going to equal then depreciation expense in year 2 of $48,000. So now I take my $48,000 depreciation expense, I add it to my accumulated depreciation, therefore I end up with $128,000 worth of accumulated depreciation. I subtract that amount from my beginning carrying value, and I end up with an ending carrying value now of $72,000. Year number 3, I'm going to go through the same process. I'm going to take the carrying value from year number 2 and pick it up in year number 3, multiply that times 40%. That comes out to $28,800. So now I take the $28,800 and add that to my previous accumulated depreciation. Now I end up with an amount of $156,000. So I take my total asset cost minus my accumulated depreciation, and my carrying value now is $43,200. And we're going to repeat this process for year number 4. And also calculate the ending carrying value for year number 4. And you'll notice my carrying value now is $25,920. So now we have to do a special calculation at the end of our useful life, end of our period. We're still going to calculate depreciation, but we're going to calculate it only on the basis that it will take our carrying value down to this carrying value here, $25,920. It will take us no lower than our salvage value cost. And as I say here, the asset in year 5 will not be depreciated below its salvage value. So we're going to take $25,920 carrying value minus the salvage value. So the amount that we would depreciate in year 5 would be $5,920, and that would take us to our carrying value, which would now be equal to our salvage value. And what we can see here is also an example of accelerated depreciation. I'm going to change the pen color again because this is going to get even a little bit more messy. Notice with declining balance depreciation, my depreciation expense in year one is $80,000, and that's certainly greater than the depreciation expense in year one of straight line. Year number two then, my depreciation expense with accelerated depreciation is $48,000, again, which is higher than the depreciation expense for straight line. It's only in year three when now my declining balance depreciation now hits $28,800 that now my straight line depreciation expense is now higher. But that's what accelerated depreciation means. It means that the depreciation in the early years is higher than would be for straight line depreciation. Okay, now let's take a look at the depreciation methodology for some of the year's digits. We're going to use the same asset facts: $200,000 asset cost, $20,000 salvage value, useful life of 5 years. And the formula is the depreciable base times the fraction of remaining years in the useful life divided by the sum of all the years in the useful life. That'll become a little bit more apparent what that means when we do our next, when we show our example formula. Now remember, depreciable base is equal to our asset cost minus the salvage value. Now let's take a look at an example of a first year calculation using the asset facts. We start off with $180,000 in our depreciable base. That's going to be multiplied times the following fraction, and that's going to be the 5 years that are remaining, since this is our first year in depreciation. So that's our first year is 5 years remaining, divided by the sum of the year's digits, which equals 5 plus 4, that's 9, plus 3, that's 12, plus 2, that's 14, plus 1. So this number will be 15. And in effect, it's going to be the 180,000 times 5 divided by 15. We'll take that down here. Here's year number one. Under year number one, we're saying there's going to be 5 years of depreciation remaining. So we take a $180,000 calculation, which is the amount of our depreciable base. We multiply that times then 5/15, which is meaning our 5 years remaining, by the sum of the digits in all the 5 years, 5 plus 4 plus 3 plus 2 plus 1. When we do that, when we calculate that out, that has depreciation expense of $60,000. So again, our accumulated depreciation is 0 from the previous year plus 60,000 equals $60,000. When we want to calculate the carrying value is going to be the asset cost of $200,000 minus the $60,000, which means our ending carrying value is going to be equal to $140,000. Year number two then, that means we have 4 years remaining after year number two. Or 4 years remaining in year, starting with year number two. And again, $180,000 depreciable base times now 4/15 sum of the year's digits. Now our depreciation expense equals $48,000. And the accumulated depreciation now becomes the 60,000 plus the 48,000. So it's a total of 128,000. That amount subtracted from our asset cost then will give us a carrying value of 92,000. And this process is going to take place through years, all the years 3, 4, and 5. And you can see where we're multiplying the 180 times 3/15, 180 times 2/15, and 1/15. And you can see the depreciation expense change with every year, and the accumulated depreciation will correspondingly increase, and the ending carrying value would decrease, and the ending carrying value at the end of the life of the economic useful life of that asset under sum of the year digits would be equal to $20,000, which is a $200,000 asset cost less the carrying value. Now, you'll probably also notice if you compare this back to the previous slide, for the first 2 years, the sum of the year's digit depreciation expense is higher, quite a bit higher than that of straight line. So again, this is an example of an accelerated method of depreciation. This is an example of depreciation, in this case under units of production. And the calculation here is, again, very simple. It's basically, again, using the same asset facts as we have in our previous examples. The formula is our depreciable base divided by the estimated units of production over the lifetime, the economic lifetime of this tangible capital asset. Now, an example would be $180,000 would equal the depreciable base, because that would be the asset cost of $200,000 less the salvage value. So that'd be the amount that we would want to depreciate. So we're going to take $180,000 of depreciable base. We're going to divide it by the estimated units of production for its useful life. In this case, we're estimating that this machine will be able to economically produce 90,000 units. So if we take the $180,000 cost divided by 90,000 units, that means every time this capital asset produces a unit, it's going to incur $2 worth of depreciation costs. And it's a simple matter then of doing the calculation. If in year number 1 we produce 5,000 units, 5,000 units times $2 per unit equals $10,000, and that equals our accumulated depreciation for year 1. And the $200,000 asset cost minus its accumulated depreciation gives us a carrying value of 190. Year number 2, we produce 20,000 units, and that means we're going to incur $40,000 worth of depreciation expense, which means now added on to our previous $10,000 of depreciation expense is we're going to end up then with accumulated depreciation of $50,000. And the carrying value then is going to equal $150,000, which is our $200,000 asset cost minus our $50,000 worth of accumulated depreciation. And we're going to continue that all the way through year 5 until basically assuming that our estimate was correct in terms of total production, we're going to end up with $180,000 of depreciation expense, $180,000 corresponding accumulated depreciation with an asset with carrying value of $20,000. Now I'm asked the question as well, what if the estimate's off and then I retire the machine at the end of 5 years? Well, I can only reduce my carrying value of that $20,000. So depending upon the amount of production or non-production, I can end up calculating a gain or loss on the disposal of the machine. Now, this is a good example of a question that, again, everybody on the CPA exam is pretty much assumed they're going to be able to calculate a simple depreciation problem. But you're going to get questions about, well, what if something changes during the year, what happens? So here's an example of that. Planet One reported equipment with an original cost of $379,000 and $344,000 for years 2 and 1. The company also reported accumulated depreciation of $153,000 and $128,000 for years 2 and 1. So those are the accumulated depreciation respectively. During year 2, Planet One purchased equipment costing $50,000 and sold equipment with a carrying value of $9,000. What amount should Planet One report as depreciation expense for year 2? So you can see this, it's not as simple just doing a simple depreciation calculation. We're going to require a little bit more than that. So when you're ready, go ahead and stop the video, calculate your answer, and then when you're ready, restart your video. Okay, the answer to number one is $31,000, and this question takes a bit of analysis in order to derive the answer. So let's go through the analysis. We're asked to come up again with the answer to the amount of depreciation expense for year two, and everything being equal, the amount of depreciation expense should equal, with no other transaction, should equal the increase in the accumulated depreciation accounts. But we have to allow for potential transactions that could affect the accumulated depreciation account. And in this case, there are some transactions. So let's go back and take a look at what happened. Now, as the problem mentions, is during year two, Planet One purchased equipment costing $50,000. Now, that fact alone should indicate that I started out with $344,000 in year one, and the amount of asset cost increased to $379 in year two. Well, if I purchase $50,000 of assets, if I add $50,000 to the 344, my asset cost should have gone up to $394,000. But it didn't in this case. It only went to $379,000. So that means there must have been some type of transaction in terms of the sale of assets where I had to remove the cost associated with those assets. So that has to be, we have to take that netting out of the increase. So again, we're saying the assets that we acquired in year two was $50,000, which we just talked about here. And the increase in assets was only $35,000. So if that's the case, if the assets only increased by $35,000, that means when we subtract out the increase that should have occurred versus the increase that we show did occur, we must have had assets that were sold with a value of $15,000. Now, we're also told in this problem that the basically equipment was sold and it had a carrying value of $9,000. So if we remember our carrying value formula, it's our original asset cost minus depreciation equals the carrying value. Well, in this case, we have the original asset cost. We also have the carrying value, so the difference between these two, if we use algebra, must have been we must have had $6,000 worth of accumulated depreciation on the assets sold. And that would be, if we recalculate it, it would be the original cost of the asset of $15,000 minus depreciation of $6,000, and that's going to equal then the carrying value of the assets that were sold. So now we know that $6,000 of accumulated depreciation was associated with an asset sold. So that had to have been removed from our books. So now when we take a look at our accumulated depreciation, it shows that we had a net increase of $128,000 to $153,000. That's $25,000. But that's net of the accumulated depreciation from the assets sold. So what we need to do is we need to add the depreciation of the assets sold back to the accumulated depreciation increase. So that means our depreciation expense for the year was $31,000. Force One purchased a machine with 4 years useful life and an estimated 10% salvage value for $80,000 on January 1st of year one. What should the company report on its income statement for depreciation for year 3 using DDB, which stands for double declining balance depreciation? So again, go ahead and perform your calculations, arrive at what you believe is the right question, and restart your video when you're ready. Now let's take a look at the answer to question number 2. And again, the question is, what should the company report on its income statement for depreciation for year 3 using double declining balance depreciation? And the answer in this case, after doing the calculations, is B, $10,000. So let's see how we go about doing that calculation. So the first thing is, when we understand double declining balance depreciation, that means twice the amount of the straight line rate. Now the straight line rate for 4 years means 1 divided by 4, or we depreciate 25% of the asset per year for 4 years. And what we're going to do is, with double declining balances, we're going to double that 25%. So we're going to convert the 25% to double declining balance, which is the 25% times 2. That equals a 50% double declining balance rate, and that's what we're going to use in our calculations. So in year 1, we start off with our beginning carrying value of $80,000 times 50% rate, so our depreciation expense calculates out to $40,000. And that means for year 1, our corresponding accumulated depreciation would be $40,000, which we subtract from our $80,000 carrying value, meaning our ending carrying value is equal to $40,000. We're going to go through the exact same process for year number 2 and year number 3. And if you follow that through, then in year number 3, we have a beginning carrying value of $20,000. We multiply that again times our 50%, and we end up with depreciation expense of $10,000. And that is the answer in this case for using double declining balance depreciation. Now you do have to be careful on the way sometimes these questions are worded. Instead of asking about, what should the company report on its income statement for depreciation for year 3, it may ask a question as example, what should the company report on its balance sheet for its ending carrying value at the end of, let's say, year 2? Some students will still go ahead and calculate depreciation and try to use that number as a correct answer when it was asking possibly for something such as carrying value, or what would be the accumulated depreciation in a point in time. So keep that in mind when you see a question like this. Okay, question number 3. On January the 2nd of year 5, so the first of the year, this company purchased machinery under a contract that required a down payment of $10,000 and then 24 monthly payments of $5,000 each. If the company had paid the full price up front, the price of the machinery would have been $110,000. The machinery has a useful life of 10 years, then that's economic useful life, and an estimated salvage value of $5,000. The company uses straight line depreciation. What amount should the company report at the end of year 8 as depreciation expense for this machinery? Now this is one of those questions where they're asking, looks like a really, really simple calculation of straight line depreciation over a 10-year useful life. So you have to kind of look sometimes for what's the catch in the question, and because it almost looks too simple. So let's go ahead and determine the answer, and when you're ready for the answer slide, go ahead and progress on with the video. And you can see from the slide here, slide number 3, the answer is $10,500 to the question, what amount should the company report at the end of year 8 as depreciation expense for this machinery? And the little glitch in the question is basically the fair market value of the machine is actually $110,000. Any payments in excess of that would be considered interest. So the depreciable base in this case would be, using straight line depreciation, the $110,000 minus the $5,000 salvage value divided over 10 years would be $10,500 a year. Okay, question number 4. It's essentially literally the same information from the third question. And again, it's a simple calculation, a straight line depreciation. But in this case, the question does vary a bit. It says, what is the carrying value of the machinery at the end of year 7? So this is one of those questions, again, with a little twist in it. And go ahead and when you're ready, restart the video so you can review the answer slide. And again, this question is, what is the carrying value of the machinery? So what is the carrying value, not the depreciation, the carrying value of the machinery at the end of year 7? So I've just also changed years. In this case, the amount would be $78,500. And as we did in question number 3, the fair market value of the machine is $110,000, and the remainder of any payments over that is basically interest. And our depreciable base is $105,000, which is our basically the $110,000 cost of the machine minus the $5,000 salvage value divided by 10 years equals $10,500 a year, just like it did in answer 3. Now we are going to do 3 years of depreciation as opposed to years 5, 6, and 7 as opposed to 4 years. So our accumulated depreciation is 3 years times 10,500 per year equals 31,500. Now in this case, the carrying value of the asset itself will be the $110,000 asset cost minus the accumulated depreciation of 31,500, meaning that the carrying value of the asset is $78,500. Let's take a look at question number 5. On January the 2nd of year 5, the first of the year in other words, this company purchased machinery for $120,000, and the machinery had a useful economic life of 10 years and an estimated salvage value of $10,000. The company uses the sum of the year's digits depreciation method. What is the accumulated depreciation of the machinery at the end of year 7? So again, go ahead and do your calculations. Also read the question carefully to make sure you don't miss important information. And when you're ready, go ahead and run the video to the answer slide. Let's take a look at the answer to question number 5. And again, the question is, what is the accumulated depreciation of the machinery at the end of year 7? And in this case, the answer is C, $54,000. So if we do a calculation on this, we know our depreciable base equals our asset cost minus the $10,000 salvage value. That means our depreciable base is equal to $110,000. Now the sum of the year's digits in this case over the 10 years, 1 plus 2 plus 3 all the way through plus 8 plus 9 and plus 10, that equals 55. So now we're going to do the calculations of the sum of the year's digit of depreciation starting in our year number 5, not year number 5 of the asset life, but in year, let's say 2005. So basically in year 5 we have 10 years remaining. So our calculation is equal to our depreciable base of $110,000 times the fraction of 10 divided by 55. And when we calculate that, that's going to come out to $20,000. Our accumulated depreciation at that point would be 0 from the beginning, and then we add $20,000 to it. So now we have $20,000 of accumulated depreciation. In year number 6, then, now we have 9 years remaining, and that's $110,000 times, in this case, 9/55, and our depreciation expense will be $18,000. So we take the $18,000, add it to the previous accumulated depreciation. We have an accumulated depreciation now of $38,000. Year number 7, then, we have 8 years remaining. So the $110,000 times 8 times the 8/55, our depreciation expense here would be $16,000. So we take that $16,000, add it on to the $38,000, and we end up with accumulated depreciation of $54,000. Okay, question number 6. A company purchased equipment at the first of the year of year 1 for $50,000. The equipment has an estimated 5-year useful life. Ming's policy is to use double declining balance in the first 2 years of the useful life and then switch to straight line for the remaining useful life. What amount should Ming report as accumulated depreciation on the equipment at the end of year 3? So go ahead and do your computations. When you're ready, go ahead and go on to the answer, the video with the answer slide. Okay, let's take a look at the answer to number 6. And again, the question is, what amount should Ming report as accumulated depreciation on the equipment at the end of year 3? And in this case, the answer is B, $38,000. So let's go ahead and do the computation. So again, we have something with we have an asset with a 5-year life, meaning that if we did straight line depreciation over the five years, that would be 20% of the asset value per year. So we're going to convert that 20% to 40%. Because we're going to do it double declining balance. So we take the 20%, multiply it times 2 equals our 40. And that's going to be our basis for double declining balance. So year number 1, our beginning carrying value would be the $50,000 times 40%. So our depreciation expense now would be $20,000. And of course, that would add to our accumulated depreciation in the first year. So our ending carrying value is $30,000, which we bring on to year number 2. $30,000 times 40%. Let me do the little time symbol right here. $30,000 times 40%. So our depreciation expense equals $12,000. So our accumulated depreciation equals the $12,000 plus the previous 20. So now it is going to be, the accumulated depreciation will be $32,000, which means our ending carrying value be $18,000. Then year number 3, when our beginning carrying value is equal to $18,000, now I'm going to begin depreciating that amount over 3 years on a straight line basis. And it's a fairly simple calculation, $18,000 remaining carrying value divided by 3 years. And that's going to equal $6,000 per year. So our depreciation expense in year 3 would be $6,000. And our accumulated depreciation then would be the $6,000 plus the $32,000 from the previous year. So our accumulated depreciation would be $38,000. Question number 7. A company's depreciation policy is to take a full year's worth of depreciation in the year of the acquisition and then no depreciation in the year of disposal. The following data is provided regarding an asset at the end of year 5. Okay, we acquired the asset in year 2 at a cost of $110,000. There's a salvage value on that asset of $20,000. The amount of accumulated depreciation at the end of year 5 is $72,000. Its estimated useful life is 5 years. So using the same depreciation method used in the previous years, and you're not told what depreciation method that is, how much depreciation should the company record in year 5 for this particular asset? Go ahead, derive your answer, and when you're ready, go on to the video, continue the video with the answer slide. Okay, let's take a look at the answer to number 7. The question again is basically using the same depreciation method used in the previous years, and you're not told what that is. How much depreciation should be the company record in year 5 for this particular asset? The answer in this case is going to be B, $18,000. Now let's see how we derive that. Okay, you don't know basically the methodology used for depreciation, but what you can do is take a decent stab at it. And then if that doesn't work, try an alternative method. So the asset was purchased in year 2, and the problem states that there's $72,000 of depreciation in the 4th year. So what I need to do is come up with need to do is recalculate some depreciation calculations using several different depreciation methods if necessary to see if I can come up with $72,000 of depreciation in year 4. So I'm going to first try straight line because that's the most simple, the most straightforward. So I have $110,000 cost. I subtract out the $20,000 salvage value. That means over the life of the asset, that would amount to $18,000 of depreciation per year. Now, if I take that $18,000 of straight line depreciation per year over 4 years, that means that I'm going to end up with $72,000 worth of accumulated depreciation, oh, by the way, in year number 4, which confirms the company in this case must be using straight line depreciation because it fits. Okay, the amount of the straight line depreciation for year 4 is obviously $18,000, as every year's worth of depreciation is an equal amount under straight line. So that would mean that in year number 5, we would also be recording depreciation of $18,000. Question number 8, at the beginning of year 1, State Distillery purchased a machine for $264,000. The company used straight line depreciation over an 8-year useful life, and there's no salvage value for this machine. At the beginning of year 4, the company determined the machine had a useful life now of 6 years from acquisition and would have a salvage value of $24,000. An accounting change was made in year 4 to reflect the additional information. So in this case, the accumulated depreciation for the machine at the end of year 4 should be, okay, make your calculations, and when you're ready, make your choice, and when you're ready, restart the video for the answer slide. Okay, let's take a look at the answer to question number 8. And again, there was a change in facts here where we went from a 6-year life, or from an 8-year life to a 6-year life, and also the salvage value of the machine went from $0 to $24,000. So in this case, when we had to change our accounting in year 4, the question was the accumulated depreciation for the machine at the end of year 4 should be, and the answer in this case is D, $146,000. So let's follow the process here. Okay, we were utilizing straight line depreciation over an 8-year period, useful life with no salvage value. So in this case, we have no salvage value, so $264,000 minus a zero salvage value gives us a depreciable base, obviously, of $264,000. We divide that over 8 years, and that comes out to $33,000 per year on a straight line basis. So in years 1 through 3, we record that depreciation. And what that means is we're going to have 3 years times $33,000 a year. So our years 1 through 3 accumulated depreciation would be $99,000. Now we find that we're going to have to change the useful life, and also we're going to have to account for a salvage value. Now we take the depreciable base of the asset of $264,000. We subtract out the $24,000 of salvage value, and we subtract out the 99 years of accumulated depreciation. I'm sorry, the $99,000 worth of accumulated depreciation. And that leaves $141,000 over the revised remaining 3 years. So our year 4 depreciation will be the depreciable base that we now have is $141,000 divided by the 3 remaining years. That means our depreciation starting in year 4 then will be $47,000 a year. So the year 4 accumulated depreciation would be our $99,000 prior accumulated depreciation plus our new depreciation in year 4, $47,000. So I say here, year 4 depreciation expense would be $146,000, but what I should be saying is our year 4 accumulated depreciation should be equal to $146,000. Question number 9. Bass-Ackwards uses straight line depreciation, and the following data was available regarding plant, property, and equipment. And you can see we have land, buildings, machinery, and equipment, and the associated accumulated depreciation with those classes for year 1 and also the more current year, year number 2. We're also told that depreciation expense was $55,000 for year 2 and $50,000 for year 1. What amount was debited to the accumulated depreciation account because of plant, property, and equipment retirement? So we're going to have to analyze the changes to determine what happened between these 2 years. Okay, the answer, or rather the question for number 9 was, what amount was debited to accumulated depreciation due to plant, property, and equipment retirements? And the answer in this case will be $25,000. And for me, the easiest way to account for these relationships is to use the T accounts that are involved in these transactions. So I know I'm going to have accumulated depreciation, and I'm also going to have depreciation expense. And I know there's a relationship between accumulated depreciation and depreciation expense. Now, when I take a look at my accumulated depreciation account, it had a balance, an ending balance in year number 1 of $370,000. So that represents my credit balance in accumulated depreciation. At the end of year number 2, it had a balance of $400,000. So that represents my credit balance in accumulated depreciation at the end of year number 2. Now, I'm also told that depreciation expense was $55,000 for year number 2. So if I recall a journal entry, or the journal entry I'd make for depreciation expense, it would be a debit to depreciation expense, and there'd be an offsetting credit, and that would be to accumulated depreciation. So now I have my entries that appear to make it fairly clean from depreciation, but if I add it up, it's going to be the 370 plus 55,000 will not equal that $400,000 balance. So I must have had some form of a debit in accumulated depreciation that would basically offset some of that accumulated depreciation balance, and the amount that would have had to have been would have been a $25,000 debit to accumulated depreciation, and that would have been due to the plant, property, and equipment retirements. Let's talk a few minutes briefly about depletion. Depletion is very much the same as depreciation in terms of concept. Depletion basically is applied to the extraction or the removal of natural resources. And if we were to define the process of depletion, it would be the process of rationally allocating the development cost of natural resources for extraction to match against the revenues these resources produce. Now, when we're depleting, when we're going to do a depletion calculation, it has to normally be made against what we call a depletion base. In other words, the total amount of cost used to develop the resources for extraction. And these normally include acquisition costs, development of the property cost, any restoration cost that the company estimates they will incur as a result of the either federal, state, or local requirements to restore property back to whatever original, either original use or back to some other type of use as prescribed by law. From those costs, and we can subtract out the cost if we sell the property. In other words, if we have a if we can actually sell the property after we have depleted the resources from it, and that's going to equal our total depletion base. Now, the depletion calculation again is very simple. It's our depletion base, which we just talked about right here, divided by the total estimated recoverable units of that resource. And then when we calculate depletion, it's going to be the units extracted times the depletion rate will equal our depletion expense or depletion costs. Question number one, and the only question on depletion. At the beginning of year one, Engulf and Devour purchased a mineral mine with extractable ore estimated 1.2 million tons. And they purchased this mine for $2,640,000. E&G will be required to restore the property at an estimated cost of $180,000. The company also estimates that the property post-mining value will be worth, we can sell it for about $300,000. During year one, E&G incurred $360,000 of development cost in preparing the mine for its normal extraction processes. The company removed and sold 60,000 tons of ore in year one. So what amount should E&G record for depletion during year one? Again, go ahead and do your calculations. And okay, let's take a look at the answer to number one. And the answer again, what amount should E&G record for depletion for year one? And the answer in this case is B, $144,000. So let's go over the calculation. Okay, we had an acquisition cost of $2,640,000. So we have to add that. That's the acquisition of the property. Also, we know that we're going to have to restore the property according to state law, and based upon the requirements, we're going to have to spend $180,000 to restore the property. Also, we have development cost in the amount of $360,000, and these amounts pertain to getting the facility and the land and so forth ready to actually mine the product. And lastly, we can reduce this depletable amount by the value of what we say the customer or the company estimates the property post mining value would be $300,000. In other words, they could probably sell the property for $300,000. So that means the depletable basis for the property would be $2,880,000. So we take the depletable basis and we divide it by the number of tons that can be economically extracted from the property, and that's 1.2 million tons. We do the division and it comes out to $2.40 a ton. So at $2.40 a ton, our depletion for year one would be $2.40 times the 60,000 tons of ore that we removed in the first year, and that'll equal the $144,000. And that concludes our presentation for depreciation depletion. Thank you very much for your time.